Hello, it's Chew Dog Charts, and today we're going to talk about a stock market bubble. What you're looking at is the 6-month daily graph on SPY, which is the S&P 500 ETF Trust with realtimestockquote.com. And most investors have probably heard what Jim Rogers said in the last couple of weeks. If you don't know who Jim Rogers is, perhaps you can look that up. But he has been right more often than he's been wrong. And basically, what he is saying in an interview with Real Vision TV from a week ago or so is that he's warning that another bear market is coming and that this is going to be horrendous, the worst. Basically, he says that this pullback is going to be the worst in your lifetime, in your financial experience. What he's saying is that the debt across global economies is pretty much what's to blame. And if you take a look at it, the debt has caused bubbles all over the place. Housing, Bitcoin, stock market, everywhere you look, there's a bubble. He went on to say that the retail investors who've been piling into the exchange traded funds will be particularly vulnerable to the next balling, basically because that's what everybody's buying. His basic worry is about the bond and stock valuations right now, and essentially about the breadth in the market. Basically, the breadth is the number of stocks moving higher versus those that are heading down. So rather than do charting, what I'd like to take a look at is some anecdotal information that I use when looking at peaks and valleys in the market. The chart we're looking at now is from Meritocracy Capital and shows the stock market bubbles that happened at more than 20 times median earnings. The period was from 1882 through 2017, and we can see here in 2017 we're at 25x median earnings. Looking back at previous bubbles, we see that the subprime mortgage bubble, tech bubble, were above the 25x, as well as the Wall Street crash of 1929. And other bubbles included the Panic of 1901 and the Nifty 50 bubble, all above the 20 times median earnings. Basically, the median earnings here we're looking at, this chart, is similar to the CAPE, except that it looks at median earnings over the previous 10 years rather than the mean average earnings. And the CAPE ratio was created by Shiller. This chart is also provided by Meritocracy Capital, and similar to the previous chart that showed that stock market bubbles happen at more than 20 times median earnings, this chart also shows that stock market bubbles happen above the 90th percentile plus valuation level. Looking at the chart in 2017, where we are today, we're in the 94th percentile, and the previous peaks above the 90% level coincided with previous bubbles and crashes, such as the 2007-2008 bubble, the tech bubble in 2000, then the peak in 1964-65, back in 1929, and then also the period in about the early 1900s. Although these two charts show by earnings and valuations we may be at a bubble, one has to consider other anecdotal information before coming to a conclusion. Personally, I myself believe we are in a bubble, but bubbles take time to form and they can last a lot longer than investors can last. This third chart from Meritocracy Capital basically shows the margin debt relative to GDP. If you take a look at the chart, you'll notice that our current level exceeds the margin debt relative to GDP that we had in the tech bubble and the subprime mortgage bubble. Essentially, we're at historical highs. So the margin debt is anecdotal information and also perhaps an indirect cause of why we might be at such high elevations with regard to the PE as well as valuation levels. So although one is going to need to compile additional information before you can come to a conclusion, right now the information I'm looking at is showing me that we may be near a peak. But remember, stock markets can continue on a lot longer than investors can continue. So we might see this elevation level continue on in here to the near future. So be careful out there trading and be cautious. This is Chew Dog Charts. Thank you.